Let's bring in our panel for the hour to dive deeper into these numbers. Joining us now, we've got BMO senior economist Jennifer Lee and Miller Tabak managing director and equity strategist Matt Maley. Great to have you both here with us this morning. First and foremost, Jennifer, as you think about the headline number that's come out, the market's clearly reacting here. Now the question pivots to what the Fed's reaction will be.
Well, good morning. Ahead of this, I was going to do some jumping jacks, but my original reaction was that this is not going to change the Fed's narrative at all. Heading into this, I was thinking, that this won't change the view that, or our view at least, that the Fed will do 75 basis at the next meeting, but it might change what they're thinking about going forward and how far into 2023 that they will keep hiking. And this was pretty much on this cruise. I mean, it was for sure the headline was stronger than expected, but everything else, it wasn't terribly exciting, and we saw the big jump in 10-year yields, and I think it looks like it's retracing some of those gains already. So it doesn't change anything. I think it just shows that the Fed has a lot more work to do.
Matt, if one bought stocks to kick off this quarter, they were part of that almost 6% gain in the S&P 500. Are they using this report to get out of the market?
Well, it's certainly going to make them give them some second thoughts. That's for sure. I mean, one of the things that that people, we're kind of banking on was this whole thought that, pivot or pause. Because this whole thing with Credit Suisse and Jesus, this is going to be a real big problem. But how much can they really, how much can they really pivot if the inflation issue is going to be a big problem and the employment picture is strong. So this has definitely got to change their minds. The only thing that I would say is just kind of strange in this marketplace today is that we have a situation where we have Korea shooting rockets at Japan. We have tensions between China and Taiwan. We have Russia threatening a nuclear war, and all the markets seem to care about is whether the Fed is going to pivot earlier than expected or not. It's a crazy market.
It is a crazy market, and it has been. So maybe, I don't know, maybe we're used to it at this point, Matt. I don't know. Jen, one of the things that stands out to me in this report is the participation rate. I'm ready to do some jumping jacks with you, by the way. Ticking down to 62.3% from 62.4%. Why at this stage of the game? Obviously people aren't getting their stimulus checks anymore, right? What is keeping people out of the jobs market at this point?
You know what? Even though we are not as tight as it used to be, I mean, I used to say that at one point earlier this year that this was the best time to be looking for a job, and it's also the worst time to be looking for workers. But it started to ease up a little bit. But at the same time, we still have a factor of almost 2. In terms of job openings to the number of unemployed Americans. So, it's still tight. There's still a lot of people who are looking for workers. So until we start seeing those numbers, coming down, a lot more of the job openings being taken off the table, I think a lot of potential workers could still be sort of weighing their options right now. But I've been saying for a long time that, if this is the time. If you're entertaining 3 job offers, for example, out there, take one, because it's not going to last for very much longer.
Matt, kind of in the same vein of that, when you think about when some of the hiring freezes that we've heard about, when some of the jobs that are perhaps being pulled off the table, when that'll really start to show up in the data, perhaps in a much more concerted or larger wave, what would you be watching out for on a timeline basis?
Well, I mean, there's always that lag, of course, and people have been saying, well, the Fed's got to already change what they're doing before we really know what the impact of their tightening policy has been. But as we move into early next year, the big question is we're going to start shifting from what's the Fed doing to what's the economy doing, and what does this mean for earnings? I mean, geez, again, I understand why the focus is on the employment number this morning, and it should be. But what we saw out of Samsung and Advanced Micro Devices yesterday or last night is really tells you that things are going to slow down fast, and if you have earnings coming down, I mean, Advanced Micro Devices is a very well-run company, so it's not like they're screwing up. It's just demand is slowed down dramatically, and that has an impact on earnings all over the globe in many different industries. So if earnings are coming down, that's going to make it much tougher to justify valuations at these levels, even though the stock market has already fallen 25%.
Matt, I really agree with you. I think that is spot on analysis. But let me push back on it this, because AMD, to your point, they missed revenue estimates by over $1 billion. Yet the stock is not doing much here in the pre-market. Do you think all of this bad news that might be coming, it just might be priced in?
Well, that certainly could be the case, because this group has been absolutely slaughtered this year. I mean, AMD down over 50%. The point is, though, is that a lot of these other groups are not down anywhere near as much. The question, though, is that just because a stock has gone down a lot, and just because it's not making a new low off of a new announcement, it doesn't necessarily mean that the situation is a great one. But again, you do make a good point. I mean, we're already down 25%, so we're going to go down another 25% before this thing finally bottoms. But I just think people need to be careful about being aggressive in buying this market, especially after we got a lot of enthusiasm after the strong bounce we saw earlier this week.
Jen, I know we're going to come back to jobs in just a second, but I do want to follow up on what we're talking about in terms of the semiconductor industry. Not even necessarily specifically there, but we are definitely starting to see cracks in corporate earnings, right? In terms of the pre-announcements we're getting, in terms of the inventory messages we're getting, not just from semiconductors, but obviously from retail as well. What does all of that tell you, in addition to the government economic data that we're getting about the status of the economy right now?
It's very challenging times for all sectors of the economy, for consumers, obviously, but for businesses as well, when they're still paying a lot of high input prices. I mean, prices have started coming down, which is obviously good news for corporations, but at the same time, they're still quite elevated from where they once were. So that's an issue, and that's definitely going to hurt profitability. And plus, they're working a lot more for wages and for salaries and for benefits and all that, just to attract workers and to keep workers on the payroll. So this is, again, challenging, I think, for corporations in general.